independent contractors and small business owners. I'm here with my Chief Furry Officer, and we're going to give you a crash course on
Resilient business finances, remaining solvent in difficult times. We're going to go quickly through these 6 steps, so pause the video to read the slides in details. The tips are simple but often overlooked by small business owners. See how many you already do and what you need to incorporate into your business practices. Whether you're just starting out or are a seasoned professional, take a look at your foundational bank accounts. But first, an explanation of 2 concepts: compound interest, the interest earned on interest when lending money. We're going to talk about how to use it to your advantage instead of being crushed by it on your credit card. The rule of 72 helps estimate when you'll double your money when investing. As an example, if you invest just $1 a day for 1 year at a 10% annual rate of return, in 7 years, you'll double your investment to $730. Your business checking and savings accounts form the foundation to your financial system. In your quest for a high interest rate with no fees, don't forget to ask about checks, ATM cards, international transaction fees, and anything else you need to run your business. Comparison shop and research for the best deals. If you're not a U.S. citizen, you can open a U.S. bank account, but each bank has its own application criteria. Know them and ask questions before you apply. Whenever possible, you want to automate your financial system to ensure savings and avoid missed payments and overdrafts. Direct deposits and auto pay can even be used to negotiate a no to low minimum account balance. Build your business credit history. In saving and checking accounts, you want to have a high interest rate because that's what the bank pays you for you lending them your cash. With credit, you want a low interest rate because that's what you pay the bank for them lending you money. In receiving lending, you're vulnerable to the harms of compound interest, but by monitoring rates, you can keep ahead of the game. Investment accounts form the foundation to long-term financial security. They're a source of lower taxes and beneficial compound interest. You want to open 3 accounts, 4 if you have employees. When weighing your options, know the terms. Consider early cash out penalties, benchmarking, and tax implications. My favorite retirement accounts for small business owners are the SEP IRA and Solo 401k. Both let you defer substantial sums of income. A Solo 401k even allows you to defer from profit sharing. Setting up automatic deferrals with irregular revenue can be tricky, but do it. For HSAs, remember you must be enrolled in a high-deductible health insurance plan. The pre-tax income helps lower health costs, and a little-known fact, you can invest the balance. Now you might be thinking, this is great, but I have no money to automate into these accounts. Well, here's how we find sensible funding. Before taking out a loan or taking on investors, look for debt-free funding sources like grants, contests, crowdfunding, and self-funding. When you invest a portion of your initial funding, the long-term gains can help pay down subsequent loans, especially if the return rates that you're receiving are higher than the interest rates that you're paying. When speaking with investors, look for interest rates that are lower than what you'd get through traditional lending or some other significant advantage. If you're offering stakes of your company, be mindful of any required return. Don't take on more debt than you need or can realistically repay. Are you really working for yourself or are you working to consume? Conscious spending habits encourage you to think critically about spending, seek the best possible value, appreciate money as a workforce, and acknowledge your role in perpetuating consumerism. In an industrial society, consumers need to keep buying for companies to keep selling and people to keep working. You have to convince people that they need to buy your widget. Once everyone has one widget, you need to convince them to buy 2 to keep the cycle going. Clever marketing links products and services to fulfilling fantasies, allaying fears, solving problems, and soothing pains. Until we no longer live life, we consume it. Both businesses and people get locked in this endless cycle, losing track of true purpose and the very real impact of continual consumption. Time and time again, we are shown that this is not a sustainable model. Breaking consumerism. The purpose of this exercise is to increase your awareness, not to penny pinch, but seek greatest value, which leads to a more naturalistic and meaningful growth model. Review your lifetime earnings and spending activities. Estimate the real acquisition cost by including variables like time, taxes, environmental impact. Identify projects that have made you compromise your vision or entrepreneurial drive. Once you have a clear sense of where the money is going, it's time to cut the superfluous and align your spending with your business values and purpose. How might your expenditures change outside a continual growth model? How much revenue you generate often has little bearing on whether or not you can and will build wealth. Think about that. We often spend our income growth before it's even realized, and debt detracts from that bottom line. Learn and practice intelligent use of money to minimize spending, maximize income, resulting in greater fulfillment, integrity, and alignment with your purpose. The value of cash decreases in time due to inflation, so invest. Invest first, otherwise you're stuck paying bills with nothing left over to grow. Taxes are our contribution to society, and they can also work to our benefit, like with retirement and philanthropy. Your business practices should work to maximize your income. Conscious spending habits take the worry out of budgeting because you're spending on essentials that meet a given criteria. The percentage of revenue going to each category can vary on industry, sector, and company-specific spending patterns. These varying cost profiles are examples from a Service, Product, and Service Center SaaS industry market report. You can translate these charts to the general recommendations above, with the wage, purchases, depreciation, marketing, rent, and utilities as your fixed costs, and the other as your investment, saving for big purchase, and flex spending. While you're building investment income, you need an emergency fund of 3 to 6 months of operating expenses. Your revenues can be a portion of your flex spending, but you can spend it, and saving for big purchases. In paying down debt, you want the lowest possible interest rate. This means you'll need to talk to your creditors and make the ask. Consolidating debt reduces the number of minimum payments you need to make each month, but know the terms. Some creditors will offer no interest debt transfers for the first 6 months, but month 7, the rates soar. Know when you'll be debt free. Of the 10% of revenue that you normally invest, use 5% for debt repayment. You can also use investment income, but consider any early cash out penalties and taxes. A red flag is when a founder buys a huge house and a fancy car when they receive their first investor payout. The likelihood that that owner is making conscious spending decisions and investing their personal income, let alone their business revenue, is very slim. This is where we're going to use the investment accounts you set up in part 1 to build resilience. You've been deferring 10% of income into investment accounts, and now you need to select investments. The investment pyramid describes options generally, but check it against the actual market. You must consider expense ratios, not just the average return rate, but the cost of returns with fees. The index fund S&P 500 has returned an average of 8% including inflation. Mutual funds can have consistent returns but have high fees. Day trading or active management of individual stocks is prospecting and high risk. No one can predict the market, only sometimes trounce it. Cryptocurrencies are not established and are considered high risk. With research, you can select and diversify your investments. Fidelity releases a report on the business cycle approach to asset allocation. Once you're over $1 million in revenue and there's more complexity, find a fee-only financial advisor. A commission or percentage-based advisor, even at a 1% fee, will eat away at your returns. Remember, other investments have different associated costs. Cars and charitable foundations are not investment assets, but have their benefits. Allocations help diversify investments. A broad-based portfolio protects against concentrated risk. Say if the real estate bubble pops, target date funds adjust risk tolerance by years to retirement. Risk is not inherently bad. It typically means a higher return rate on investment if things go well. You need to manage risk for consistent and long-term gains. Diversify within your area of expertise and outside of your industry. Whether you're an employee or an owner, consider any investment in your company's stock as aggressive growth investment. Don't invest more than 25% of your portfolio in your own company's stock. Once you automate your financial system and manage your finances, you need to periodically rebalance investments and revise your strategy based on actual performance and evolving needs. Remember, you're playing the long game and for keeps. Your capital and income needs to meet certain criteria and be in alignment with your target asset allocations and goals. When is it enough? For you, it's when your personal investment income can comfortably cover, with a cushion, your living expenses and needs. For the company, there is no retirement. Centennial companies continually reinvent themselves to stay relevant. To achieve resilient business finances, you want the company's investment income to comfortably cover operating expenses with a cushion and contribute to natural growth. Remember to do your research to find the strategies that work best for your business.